So now, in this book, it's a lot more than the subprime, more predatory side of subprime mortgages. I write about a range of businesses that are catering to the working poor. I call them Poverty Inc. businesses. A big part of that world are the payday lenders. They're making these 2-week loans, typically short-term loans, typically 2 weeks, against a person's next paycheck or government check. You've got used auto finance companies that are charging interest rates of 18% a year on a car loan, 20%, 25%, sometimes more in certain states. You've got rent-to-own, which is the strange business of renting people their furniture, their appliances, their TVs by the week. The brilliance of rent-to-own is they've figured out a way of selling for $1,200 the TV that would cost you $500 at the local electronics retailer. The instant tax mill business, Jackson Hewitt, Liberty, a bunch of other companies are in this business. This is a business that basically lasts for 1 month out of the year, and it takes advantage of people who are so desperate for quick cash, they'll pay a huge premium to get their tax refund today or tomorrow rather than waiting the 2 or 3 weeks for the IRS to send them the check. And you know, the poverty business isn't new. We've had pawnbrokers dating back centuries. The big cities in this country started seeing check cashers in the 1930s. Rent-to-own started getting popular in the 1960s. What's changed is the working poor have become big business, big Wall Street paying attention business. But I'll confess that most interesting to me were the people like Alan Jones, these pioneers of subprime. And I just was really interested in what makes them tick. You know, they're selling such a controversial product, and I just really wanted to hear their perspective. And so it was just fun for me personally to hang around with these people that normally I wouldn't have in my life. So I spent 2 days with Alan Jones. He took me to a wrestling match. He showed me where he grew up. I met some of his friends out drinking. He also, I had one of the more surreal moments of this project on our first day of lunch. The payday lenders charge a fee that if you express as an annual percentage rate is really high, typically 400, 500%, but he was trying to make the point that with defaults, with the cost of the lease, the cost of employees, and other parts of the operation, that he wasn't making nearly as much money as you might have thought. So he pushes away the dishes, pulls out a calculator that I guess he always had in his pocket, just pulled it out. And he says how much he makes per store and divides it by the number of hours the store is open, and pulls up the calculator and says, $7.88 an hour, that's practically minimum wage. Does that sound so much to you? And so I just say, rather than answering, can I borrow your calculator? And he just told me he's got 1,200 stores and here's how much they make. And I did the math, and he's making roughly $25 million a year through payday lending. And then I did some more calculations, and it works out, given his calculations, to $10,000 an hour. And yeah, actually, I do think that's a lot of money. At the same time, you had check cashers getting into the payday business. You had the big pawn chains getting into the payday business. And by 2006, 13 years after the founding of the industry, there were more payday lending shops in this country than McDonald's and Burger King's combined. So how to get so big, so fast? Geography is one factor. The banks fled the working class communities. The banks fled inner cities and rural communities that had fallen on hard times, creating a vacuum for the check cashers, the pawnbrokers, the payday lenders. Broader economics played a role. The bottom 40% in this country, their wages have stagnated over the last couple of decades, while meanwhile rent, health insurance, heating oil, have all gone up, so they're being more and more and more squeezed. Lobbying played a factor. Most states have a usury cap in place. There's only so much you can charge for loan, and so the industry, the budding industry, spent millions of dollars on lobbyists and campaign contributions to convince local state legislatures that these were short-term emergency loans. These were 2-week loans. Why are you applying an annual percentage rate to them? It's a fee for the money, and people pay it back in 2 weeks. It has nothing to do with an APR that was convincing in lots of states. So I think at its peak, 37 or 38 states allowed for payday loans. Another factor was capital. I was really surprised by this in this book, that whether you're talking about payday loans or any of these businesses I'm talking about, the big name brand banks funded a lot of the growth. Advance America, before they had opened a single store, they had borrowed $50 million from Wachovia, Nations Bank, Wells Fargo, and Bank of America. So, you know, the big name brand banks recognize what big businesses was, is Morgan Stanley, one of the most respected investment houses on Wall Street, that took Advance America public. You know, the payday execs will generally acknowledge that a payday loan is very expensive. But then they'll point out that so is a balance check, and so is the credit card late fee, and all these other costs that, you know, are an alternative. And so their logic is, if you're facing 2 or 3 bounce checks, and you could borrow a quick $200 and avoid those, it actually makes economic sense. If it costs you $40 or $50 to get a $200 payday loan, and you could avoid 2 or 3 bounce check fees, it's true. That makes economic sense. The problem with that is even Stephen Schlein, the head of the payday lending industry trade group, you know, he'll tell you that the average person, the typical customer, takes 2 or 3 months to pay back one of these loans. So suddenly it's not $40 or $50 for every $200 borrowed. It could be $100, $150 for the $200, and suddenly the equation doesn't quite work out. You talk to the academics, you talk to the consumer groups, and they'll tell you that the average customer takes out 12 to 13 payday loans a year. So that means that for half the year, these folks have these loans. Again, if you're talking about a $300 loan, you could be talking about $600 in fees for essentially the same $300 loan that you borrow, pay back, borrow, pay back, borrow, pay back. The payday lenders will tell you that it's not fair to express their fees as an annual percentage rate. You don't go to a hotel and say a room is $36,500 a year. They tell you it's $100 a night. But then you think about the people who are taking out 21 or more of these a year. That's not a theoretical interest rate. That's more or less the interest rate they're paying for their money. They're paying an interest rate of 400 or 500% a year. There's 2 million or more of our citizens who are paying on a $500 loan $2,000 in fees. So another person I met while doing this research was named Chris Browning. She ran a store in Mansfield, Ohio for 10 years. You know, the payday lenders sold this as for emergency loans. The sick kid, the broken car, got to get to work. But what really troubled, one of the things that really troubled Chris was that her computers at Check and Go were programmed to every morning spit out the names of all the people who hadn't been in the store in 60 days. And then she was instructed to call those people to try to get them back. And she's thinking like, wait, we're here for an emergency. They weren't just meeting a demand, they were trying to create a demand. All the big chains, from what I saw, have cards that if you bring somebody in, you bring in a coworker, a friend, family member, we'll give you $20 off your next loan. Browning complained about what she called the upsell. You qualify for a $500 loan, but you're only asking for $200. Now, this is a dangerous financial product. It's very, very expensive. but yet she was instructed to ask if check and go no less than 3 times. Like, you understand you could borrow $500, not $200. And though I think what bothered her most was the saturation problem. She opened the second store in Mansfield. It's a town that, you know, in Ohio, fallen on hard times. They used to have a Westinghouse plant. It closed. They had a tapping plant. It closed. There was, you know, a lot of flight of industry, and, you know, within a half dozen years, there were 27 of these stores, and there were 3 within eyesight of where her store was. And, you know, idle moments, you just stare out the window and watch almost like a human pinball. Someone would park in her parking lot and take money from her, pay her back, whatever they're doing, and walk across the street, then walk to the place next door, and then walk to the third store, and then come back to her car and drive away. And of course, they're borrowing, paying, and borrowing. She, you know, got to know these people. It's the same people, you know, month in and month out that she was dealing with for the most part. And they would tell her, like, we owe 2 or 3 or 4 stores at a time. So what might have started as a good idea, a payday loan, it was a saturation problem. Even Billy Webster, the guy who created Advance America, the biggest of these, you know, acknowledged that that's some of the trouble here, that it's just too easy. There's just too many of these, and there are all these people who are ending up owing to 2 or 3 or 4 stores at once. So payday lending, the payday lenders have had their victories in fights. The consumer groups have had their victories in fights. And then there's kind of been more of these in between. In the book, I read a lot about Ohio. Ohio 2 years ago had a ballot referendum a lot like yours. They said, we're going to cap these rates at 28%. And it passed pretty overwhelmingly, 62-38, if I'm remembering right. And that was in November of 2008, during the presidential election. 2 years later, the payday lenders, of course, are charging 28% interest. That's all they're allowed to charge. But they're charging a $15 application fee. They're charging a $10 credit check fee. Some of the more aggressive are giving people their money in check and then charging a check cashing fee. And lo and behold, the 391% APR that the payday lenders were making off their money before the law changed, they're making that, if not more, in some cases. And so Arizona had a similar ballot initiative, and the payday lenders got out of the payday lending industry, but then they got into the auto title, or many got into the auto title lending industry, which is even more expensive in a way. They charge less interest, but you also have collateral. You're holding up, you're giving the title to your car. And so they're charging 200, 300% annual interest rate on their loans, and yet they have a pretty valuable piece of collateral in their hand. So I do want to close with one thought. I'm kind of going a little bit over, sorry there, Steve. But you could close down payday lenders tomorrow, and I guarantee you that bounce check fees will go up, and there'll be more credit card late fees, and that the same people who are going to the payday lenders are somehow, some way going to figure out a way that there needs to be some other solution. So I applaud Montana for Initiative 164. You know, they're debating this issue, and you know, you're paying attention to what's going on with a large segment of the population beneath our noses, but this isn't the end of anything, it's the start. There needs to be alternatives in place where people can get these short-term loans. There is a need. The payday lending industry makes $40 billion or so of these loans a year, $200, $300, $400 a time. It's clearly a huge need. And yet, outlaw the payday lenders, and there's going to be a vacuum. So, thank you very much, and I guess we have a few minutes for questions.